Recording.
John, we got a bridge loan to talk about here. We got Barbara and we got Mike, and they are selling their home right now, and they're looking to buy a home. And like this bridge loan is sounds like it can work for them if you could explain it better than I can. Okay, so the house here are the numbers. Explain it to Mike, and to Barbara for me.
Okay. So yeah, we're talking about transition loan and talking about the benefits first. Why would you do this? Well, right now there's not a lot of inventory on the market. You find the home you want to jump on it, you want to be able to make a cash offer so you're ahead of the competition. So that's what this loan enables you to do, is to pull that equity out of your current home and use it to buy your new home without selling your current home first. So
Okay, so
that's it in
this
a nutshell.
got okay.
So Eric, we calculated the sales price on the current home at 680,000.
Correct. I put 680s for worst case scenario because we know based on the comps it will sell at 680.
All right. New purchase price 500,000
I
for
put
this.
500,000 because if we are able to get cash, $500,000 cash can be a strong offer for a home that they're looking for in Talavera, and
Okay.
that's why I use 500,000.
All right. And then the current mortgage on the current home is 189
Right.
approximately for the payoff.
Correct. So this is what they owe on their current home right now. Once they sell, they will be using the proceeds to pay it off.
Okay. So basically what we do is we take the sales price, what your home is going to sell for, what we estimate it's going to sell for, and we take the purchase price of the new home. We add those two together. That's the next number, the total value. That's 1,180,000. And for this transition loan, we will loan you 65% of that amount, which is, after Eric marked it out in red, 767,000. So that would be the total loan amount available.
Okay, time out.
Mhm.
So Mike and Barbara, you look at the screen here, your cost to sell your house will be 680,000. To purchase your new house, 500,000. They're gonna add that value up together right here. This is gonna get added all up, and you're gonna have a value amount of 1,180,000. The bank with this loan will loan you 65% of that amount, which comes out to $767,000. And once you get that amount loaned to you, your obligation is to pay 189 of your current loan, of your current home, to get off the book. And then you're free to make a purchase of your new house. You will have 578,000 once you make that loan pay off. Okay, right, John?
Yeah, so we take the 767 and we pay off the current mortgage on your house. That makes it 188,000, subtract from 767, puts us at 578. So that's
Gotcha.
the amount you have available to purchase a new home. Based on this scenario, we're looking at 500,000 for the new purchase. That's going to leave you $78,000 remaining funds available. Out of those funds, a couple things. It's not cash, so it's not something you can take out and use towards paying off debt. It has to be applied to items within this loan scenario. So we have estimated closing costs. Estimated closing costs 4.22%, 32,330. Once you subtract that, we're going to finance that in. Once you subtract that from the 78,000, that leaves us a remaining balance of 45,670 available out of your equity.
Okay, time out. So let's go back to here again, because Barbara just whispered in my ear, and she's like,
Okay.
I have a question. So so she asked me, so wait, your 78,000 here that's available funds after putting cash onto the house, the new house, I can pay for the closing costs that's associated with that transaction of 32,330. I can pay for that from this remaining funds.
You can pay for the closing costs associated with the transition loan. Let's
With the
clarify that.
transition loan.
Not with the new purchase, with the transition loan.
With this transition loan. With this
Yes.
transition loan, to get this done, 32,330 can be paid for with the remaining funds.
Correct.
Only thing that needs to be paid, right?
Yep.
Okay. And now I have 45,670 left over remaining.
Yes.
Okay. And so let me just clear my screen here.
Okay.
And then so Now out of this 45,670, what do we do with this? I paid for the closing costs.
So next step, it's a this is a short-term loan. It's a transition loan. We write these for 6 months initially. They can go longer if we need to, hopefully not. But based on a 6-month scenario, interest only, your interest only payment on that loan amount, which is 767, remember, is 6,072.08. So you can take a portion of that 45,670 that's left, and you could finance that if you want, so you don't have to pay it out of pocket. Basically, the way it works is we take and calculate 6 months worth of those payments. It's 36,000 and change in this scenario, and we'll take that and set that amount aside out of your equity to make those payments for you. Now, that doesn't mean you're going to make all 6 payments. If Erik does his job, sells your home in 2 to 3 weeks or a month or 60 days, then as soon as it sells and closes and funds, those payments stop. And the remaining amount that we set aside goes back towards reducing your loan balance. So let's say you have 30,000 left, you sell your home in 2 months, you have about 30,000 left in this equity balance. Well, that's going to come right off the loan amount. And that means that you're only going to owe 737,000 on the loan instead of 767 at that point.
Okay, so let's rewind real quick. So because it went over my head. For some reason, Erik is not smart today. I gotta learn now. Okay, so Barbara gets it, Mike doesn't get it, and I'm with Mike. Me and Mike don't get this. So let me just make sure I get this. Okay. So here's my remaining balance.
Mm-hmm.
And what you're telling me is that the loan amount, my payment of 6,072, my interest only payment is based on this loan amount of 767,000. So the payment is for 6 months.
Mm-hmm.
Correct, right? You guys built it in that this has to be done in 6 months, or else I'm going to be paying this interest only payment out of my pocket.
Well, if you want to, not you remember, we're recording this, it's on video, so Barbara and Mike are going to hold you to that.
Oh, not my pocket, their pocket. Right?
So, but yes, I mean, like I said, the loan term can be extended. Sometimes they go 12 months.
Right.
But we want to try and avoid that scenario because then you're just paying more in interest out of your equity.
Correct. So we pricing to sell, not to sit. So this should be done based on the days on market within 30 days to 45 days. So
Right.
just to clarify, John, let's get back to it here. This payment, interest only, 6,072. It's every month. This payment is interest only, and it's coming from the 45,670 fund here. So I can finance these payments monthly with these funds. It's not coming out of my pocket. And
Yes.
based on what I'm hearing, you already have it calculated, built in, of up to about 36,000.
Yeah, 6 months worth. And so,
Right. So basically, there's going to be 9,000 remaining left in this account. And this 9,000 gets into the loan amount, dropping my loan balance from 767 to 756. Oh, 758. 758. So it comes down. So the more equity that's there brings the balance down. So the faster I get my home sold, if I get a home sold in a month, 6,000, I only made one payment, then that means the about $40,000 or $39,000 rolls right up into this loan amount, bringing my business down to about $729,000, right? So that's how this has to work, right? Sell quick and get out of this transaction with equity.
yes.
Okay, got it. Okay, so interest only payments coming from this fund, it's already included in here. Now here, 632,000. So this is coming from, I'm gonna come in now, Barbara and Mike, because when I sell the house, worst case scenario at $680,000. After you paid commissions at 5% and your closing costs at 2%, together that is 7%. Your net after that house is sold is going to be $632,000. That's where this number is coming from. Okay, again, your commissions and your closing costs sold at 680. That's your net bottom line. Now, after You sell and your net, you pay off what you can of your loan amount of 767. You pay off and you're gonna have 134,000 left over as a remaining balance to finance, to refi into the new home. John,
Yes,
is that correct?
that's correct. Yes. So then whatever you net out from your current home is going to go towards this loan amount. And then whatever's left is going to be applied to your second home, your current home, your new home. And you can refinance that amount. So you'll get very favorable terms because your LTV, your loan to value, you have a house that's worth 500,000 and your loan amount's only going to be between 100 and 134,000, depending on
Now,
how much interest you save.
yes, so I was about to get into that. So if I sold my home in 2 months,
Mhm.
$12,000 in interest I paid, that means roughly 12,000 minus 33,000 will go into 767, bringing it down to about 739. So
Mhm.
this 632 will be subtracted from 739 instead of
Yes, you need a little over 100 grand that you
correct.
still owe on the loan, so to speak.
Right. So this
Um,
number can come down the faster we sell.
yep,
Gotcha.
yep.
Okay. And now currently in the home that we're selling together as a team here, the balance on that house is $189,000. You see that right here? So when we move into this new house, we're gonna have a balance potentially of 134,000
Or less.
or less. And the
Mhm.
house that I want,
Yep.
the house that I want to choose, I could get it within a week.
Mhm.
I can make an offer within a week with this transition loan. Yes or no?
Yes.
Okay. 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 And
I was
so,
waiting for the question. Okay,
yeah.
yeah,
Okay.
absolutely. These are super fast. Just Barbara, Mike, to let you know,
Okay.
there's not income qualification. There's not credit qualification on these. These are done in-house with our portfolio division. They're very quick. And so there's no issues with, it's not like, oh, I got to do the loan now and start paying interest and then hope I find my home. It's more you find your home, and then we put it into place right away, and you close on your home. So
Okay.
within a week to 2 weeks tops. So, on a regular contract, that's pretty fast closing. Typically, if they're doing regular financing, you're talking 30, 60 days.
Okay. And so if a situation, let's say I don't use this loan, and I wind up selling my house and I have to find my house. I'm gonna be, I don't want to have that pressure of, oh my God, I'm gonna be closing. I haven't found my house yet. I'm gonna
Yeah.
have to move with my son, or I'm gonna have to find a place to live and or rent an Airbnb or rent out an apartment or something along those lines that's gonna cost me money. It's gonna cost me fees and storage. It's gonna cost me month rent, month deposit. It's gonna cost me thousands of dollars as well.
Hmm.
In this situation, I'm paying the interest only 6,000, but I'm gonna get the house that I want. We have the funds here. Everything is written out. I'm gonna have a lower mortgage than I currently have now. Granted, a higher interest rate, but a lower balance.
Hmm.
Correct? So this is almost like a wash.
Yeah, you can look at it that way.
Okay. Is there anything that else that you haven't told me that I need to know?
No, I mean the loan's very straightforward. And like I said, you have to weigh the benefits as for your particular situation, but it does I think give you a great benefit as far as, first of all, putting you in first position for the house you want to buy, since it's cash offer versus, somebody else that comes in with FHA financing or whatever. And then, it gives you that ease of, I don't have to stress where am I going to live if I sell my house and I can't find the house that I like. So you can stay in your home until you find the house you like, and then you can push the button, do this deal, get it done, and move forward.
Now I remember you said this is only has to be done for house. Can't use for car payments. Can't buy another car with these funds. You have to use it towards the transaction. Question
Correct.
is, we move in. I got $100,000 balance loan. I wanted to refi, get an extra 50 grand to do some improvements to the home. Can it
Hmm.
be done at the same time?
Yeah, it's a refi. So we have a lot of different products for refis. You can do everything from a HELOC first position to a cash out refi, whatever's going to work best for your scenario. So if you want to do some improvements on the home, some upgrades, things like that, then that's absolutely an option because once again, your loan amount's super low compared to what your house is worth for your new home.
Okay. All right. So we have about 2 minutes left. Barbara, do you have any questions? No. Mike, do you have any questions? No, we can't ask that, Mike. All right. So now I want to thank you for your time and for sharing this information. And I'm sure my clients found it helpful and useful. And we're going to share it. We're going to talk about it. And we'll keep it as an option.
All right. Sounds good. Happy
All
to help.
right. Thank you, John. I'm going to stop recording the video now so we can send
Okay.
this over to Barbara and Mike.